All right, hello everyone. It's been a little while because it's been holidays and I don't work on holidays except when I do, which is a little more than I'd like to. But it's the first day of term 4 and we're going to start off hopefully with a really simple video that's going to help out with a lot of simple problems people tend to have with demand supply diagrams, elasticity diagrams, and aggregate demand, aggregate supply side diagrams. This is just going to be a whole bunch of drawing and explaining the labeling and how different changes affect the diagrams. So now, thanks to one of my students' constant requests, I have a drawing tablet, which means that we can do things a little bit nicer. And I already have axes on the other one, but that's a lot quicker then and a lot less dodgy than the ones that I used to do on the just with the mouse. So we'll get straight into this and start off pretty simple with demand supply, and then we'll get into elasticity, and then we'll get into aggregate demand, aggregate supply. So ever since 2016, you have to draw a demand supply diagram on the end of your exam. And often I say it's also useful to draw them when you're doing multiple choice, even though there's no marks for it. So when you're doing it multiple choice, obviously labeling is not important, but when you are doing it in the exam, labeling is really important. And the mark allocation for the diagram has been a bit all over the place. So you want to make sure that it is pretty spot on when you do it so you don't lose any marks. So first up, what we're going to want to do is label the axes. So we've got, first up over here, we've got price. And often you'll do in brackets whatever units that price is in. And then down the bottom over here, we have quantity. That's really important to have both of those. And often you might have, if it's in thousands or if it's in millions, whatever it is, it's good to have the units there because it makes the rest of it a little bit easier too. What I always tend to say is when we draw demand, we draw it like that as a relatively straight line. We label it D or D1 depending if there's going to be shifts and stuff. So that's, I always say, the simplest, dumbest way. I always remember this. If you need to know which line is which, demand starts with D, and therefore D down also starts with D. Therefore demand goes down. It slopes downwards. And then we've got supply. If we draw it over here, supply has the word up in it. It slopes upwards. Supply is the upward sloping line. And then you always need a title. So when we look at this, it's going to be market for, and then whatever it is the market for. And that's pretty important. They're the main things that you need. Also, if you want to be an overachiever and make sure you don't lose anything at all, it can be good to do the equilibrium price and the equilibrium quantity just marked out to be clear. I haven't often seen a mark allocated to that, but I reckon it's a good idea. It takes no time to actually do that extra, and it's right in there. All right, so that's the general, just straight up what the diagram looks like. Then I want to talk about some things with shifts. So what we're going to do, we're going to write over here. Where's my mouse gone? So we might go a red pen just for this to have a little bit of information over here. So a favorable shift with either line is always to the right. And unfavorable is always to the left. That's relatively important. You need that to get it right. But then if we draw, so like say for example, a situation that's going to cause a favorable shift of demand. So successful advertising. I say successful because advertising isn't always successful. Successful advertising is going to shift demand to the right, and we're going to get a whole new demand curve, which we're going to call D2. Also the title of the Mighty Ducks 2. Great kids sports movie. So we get that shifting over there. I like to draw an arrow just to kind of show that it's definitely shifted in that direction. And what's going to be really important is often there are questions after this. You get 1 mark for drawing the correct shift. Then often there's questions about how you get to that new equilibrium point. And we've talked about this a little bit in previous videos talking about past exam questions. But when the shift first happens, people are demanding more at the same price. There's been no real other change there. People are just demanding more at the same price. And then, so in the short term, a shortage happens because people are demanding this new amount over here, which if we draw a circle around, it's just there, they're demanding that much. but supply is still at that original equilibrium quantity. And so there ends up being a shortage there. And what happens when there's a shortage? Well, consumers bid up prices, and then they end up bidding them up until there's a new equilibrium formed where the price is a little bit higher and the quantity is a little bit lower than it was at that point before. So we've got QE2 and PE2 over here. And if we draw a dash across to that, that's how we get to that new equilibrium point. And that's pretty important. So that's for a favorable shift in demand. Let's see if we can clear it off and do an unfavorable shift. So using my fancy drawing tool to get rid of all these dashes and well, as many of them as possible. This is just blowing my mind. Technology right here. Get rid of QE2. We'll draw the demand line back in. And the supply line because it goes upwards. And then we'll do an unfavorable shift in demand. So if demand shifts unfavorably, we're going to get a new demand line over here. Call that D2. And then what's happening? So if we look at the original equilibrium price, there's suddenly a lot less demanded at that price than there used to be. And so what's going to happen? There's an oversupply. When there's an oversupply, what do businesses do? They start decreasing the price to get back to that new equilibrium point because they want to clear their stocks. They want to clear those out so we get to a new equilibrium price here. So you end up getting to, because of the oversupply, you end up getting to a new equilibrium point where the equilibrium price has fallen and equilibrium quantity has fallen also due to that unfavorable shift. So that's with demand. So we've done those. Excellent. Now we'll look at supply. So while I'm doing this, what kind of things can cause unfavorable shifts in demand? Well, it could be changes in people's attitudes. It could be decreasing price of a substitute. It could be government legislation banning something, things like that. For positive demand shift before, the example that I'm always going for at the moment is masks. Legislation made people get masks. That led to a favorable shift. But now if we go for supply, so a favorable shift in supply is going to look like this. I'm going to get S2, S1 there, move in that direction. What's going to cause a favorable shift in supply? Well, anything that either makes a business more efficient or decreases their cost of production. Any of those two things. So when a favorable shift in supply first happens, they are supplying more at the same price as before. So they're going to be at a whole new point from that first equilibrium over to a point over here. And then eventually that creates an oversupply, the same kind of logic as before, until you get down to that new equilibrium point. Then if we do an unfavorable shift in supply, so if cost of production increases or they become less efficient somehow, so let's say wages increase. Businesses want to supply less and therefore that causes an unfavorable shift. Well, in the short term, that causes a shortage. Consumers bid up prices until you reach that new equilibrium point where the price is higher and the equilibrium quantity is lower. So that shifts. Relatively simple overall, but can get confusing. The really important thing is to highlight that either the delete. You need to do either the shortage or the oversupply. That's the really, really important thing to talk about. Now briefly, I just want to talk about expansions and contractions, which are also really important. So if we've got the demand line, expansions and contractions are only when there's a change in price. So expansion and contraction. So with demand, when the price goes up, it leads to a contraction in demand because you're just moving from one point on that line to another point on that line. So you're just moving along it. So you might go from this point where this much is supplied and demanded to this point up here where a lesser amount is demanded. And that's it. That's called a contraction of demand. Then if the price falls, so if price decreases, it does the opposite. So it causes an expansion because people demand more when the price is lower. Then if we look at supply, got our upward sloping line. When the price increases, there's an expansion of supply because we move up the line. Suppliers want to supply more when the price is higher because it's more profitable. And then when the price decreases, there is a contraction of supply because they want to supply less because it's not as profitable for them overall. And so that's kind of like key things for just straight up demand supply diagrams. Next, we're going to look at elasticity, which is where it gets a bit more complicated. Haven't really seen VCAR make people draw elasticity diagrams other than in multiple choice. Either way, if you do, it's going to be relatively theoretical. So things you're going to need to know or remember is inelastic is always a steep line, and elastic is always a flatter line. And that's really important. And that's an easy way to remember which one is which. So if we looked at, say, for example, we should still label the whole thing. So we got our price, we've got market for, and we've got quantity. All right, so let's say, for example, if we go for face masks, they've recently just changed the ruling around face masks. Now, relatively soon, you're no longer allowed to use scarves, buffs, anything that isn't a fitted face covering. So face shields are out, things like that. And so if we look at the demand for face masks, so if we draw the demand line, demand slopes downwards, it's going to be inelastic. And that means it's steeper. And the reason why it's inelastic is because it's a necessity, meaning that you don't really have a choice. Legislation said you need to have that. And therefore, if the price increases on face masks, it's not going to affect the quantity demanded very much because people need it regardless. Some people might just be like, well, if I have to buy a fitted face mask now, I'm just never going outside ever, and therefore they won't demand more. But the majority of us are still going to go outside and we need that fitted face mask. Therefore, we are going to buy it regardless of the price. And so that makes it inelastic. The inelastic diagram looks like that. And that's kind of the reasoning behind that, because it's either a necessity or the time period is short, you need it very quickly, and therefore you're going to pay the price no matter what. Other things that are inelastic are things that are addictive because people will buy it regardless of the price. Then we will look at inelastic next. So we'll get rid of face masks because it's not going to be relevant. So we're going to look at an elastic demand line. Elastic demand line looks like this. It's a lot flatter. As you can see, if there is a change in price, so if we have like P1 and P2, P1 is going to be like here. If we were to draw that quickly, and P2 is going to be all the way over here. So we've got Q2 and Q1. As you can see, a tiny decrease in price has led to a massive change in the overall quantity demanded. And so this is for things that are like luxuries that you don't need right away. You can either wait for. So one that's relevant to recent exams is they had this for the market for housing. They got people to talk about what if houses were elastic or inelastic, and houses tend to be elastic because you've got other options. You can rent, you can wait for the price to change. And so if the price of houses decreases a little bit, the demand often increases quite a lot. And so that tends to be the logic behind that, of a small change in price leads to a massive change in demand. I always tend to think about this with like things like ice cream for me. My favorite example, and I've used it in videos before, is like connoisseur ice cream. It's like usually $10 or $11 a 1 liter tub, which is ridiculous, but sometimes it goes on special for half price. That price dropping by half leads to a significantly larger increase in demand because the shelves are bare by the end of the week. And that's because it's elastic overall. And then we're going to get into supply. So while I'm rubbing this out, there's also unit elastic, but you're never going to get asked a question of unit elasticity in short answer because that's just your normal supply and demand lines, the 45-degree angle. So don't worry about that. It's not a big deal for you to worry about. So if we look at inelastic supply, so a supply line sloping upwards on a very steep angle, What kind of things are going to be inelastic in supply? Well, things that they can't supply more of when the price increases a lot. Because as we know, businesses are profit motivated. So if we have P1 and P2 to have a small increase in price, well, it's a fairly large increase in price. The increase in quantity is very, very small. And so this is for things that often things like perishable goods or goods that take a long time to grow. So if we had like the market for tomatoes, if tomatoes were $1 a kilo today and tomorrow went up to $100 a kilo, businesses aren't able to supply more because they have to grow them. They can't just suddenly have thousands more to supply because they're perishable. They take some time to grow. There's a time period involved, and therefore they can only supply a little bit more despite the increase in price. And so these are inelastic in supply. Then if we look at elastic supply, once again, the flatter line, we tend to look at elastic supply as being like this. And this is where a small change in price can lead to a massive change in quantity supplied. So we have P1 like right at the start here, P2 is a little bit higher, massive change in quantity supplied based on a small change in price. And what kind of things do that? Well, things that are storable or things that can be supplied a lot quicker. So for example, tinned goods, if we look at tinned tomatoes instead, so if we change tomatoes up here and say tinned tomatoes, they last for almost forever in storage. Honey, same kind of deal. Because you can store them in a warehouse, if the price changes, you can suddenly supply a whole lot more because you have it there ready to go. And that's pretty much it for supply and inelastic and elastic diagrams. Rarely do you ever really have to talk about both of them and their elasticity together at the same time, unless VCAR suddenly decides they want to be jerks in the near future. That's hopefully it for them. Then lastly, a common request I've gotten from my students and some other students are aggregate demand, aggregate supply side diagrams. So these come up looking a little bit different depending on what you're looking at, but we have to label our axes general price levels. For any How I Met Your Mother fans, general price levels. And then we've got real GDP down the bottom. It's really important to label the bottom axis real GDP, otherwise it's wrong. So then we've got aggregate supply line, which curves upwards like this, and aggregate demand line, which is often either a straight line like this, or sometimes it's curved in the opposite direction. I prefer the straight line just because it makes more sense to me. And I feel like it works a little bit easier. But sometimes you see it drawn like this. So if I draw it over here, sometimes you see it and it looks like this. And I just don't like that as much. It's harder for me to follow. I find this way is easier to explain to students. So when we look at these lines in general, basically there's a certain price level here, down the bottom here, where no matter what, a certain amount is going to be produced. So that tends to be like this amount down here. No matter what the prices are, we're going to produce that much because that's our basic needs and wants that are going to be supplied. So we need to produce that much regardless. And then there's going to be a point, an equilibrium point where aggregate demand and aggregate supply are equal, which is great. And then we've got a point up here where we flatten out here, that's when we're at our productive capacity. And we cannot produce any more in the short term without changes. So we need to increase aggregate supply because we're at our capacity. And if aggregate demand increases to a point where it's on that upward turn, it causes demand inflation because prices increase rapidly because we can't actually produce any more. So let's get into drawing some things that will show off all of this. So an upside with these graphs is there's never really numbers associated with them. It's more theoretical, so kind of things that occur. So let's look straight up. So what's going to increase aggregate demand? So let's say, well, tomorrow they're releasing the budget on the 6th of October for the first time ever, and there's apparently going to be instant tax cuts. So instant cuts to personal taxes, they're saying people on average are going to be $1,080 richer, depending on what they earn. That's going to cause a favorable shift in aggregate demand, or it should, because of the increased consumption spending. And we're going to get AD1 over here. What's going to happen there is if demand increases at a rate faster than aggregate supply can keep up, that's going to cause demand inflation, because as you can see, the general price levels are going to be rising, but real GDP can't increase anymore in the short term. So that's what tends to happen when aggregate demand increases too quickly. That's a favorable shift in aggregate demand. And then if we have an unfavorable shift in aggregate demand, we see that real GDP starts to shrink. You see that we're producing less overall, and price levels tend to decrease as well. So that can lead to deflation and also less economic growth in total. Other things that are important here, so we've got aggregate supply. Shifts in aggregate supply are exactly the same as shifts in supply. Things that change your efficiency or cost of production. So if they change unfavorably, they shift to the left. So we get a line over here that looks like this. And as you can see, when things shift to the left, prices increase. So increase prices, and quantity, or the real GDP, falls. That's what we call cost inflation. So cost inflation is caused at that point. So if you ever have to describe that, cost inflation is occurring when there's an unfavorable shift in aggregate supply. Then if we have a favorable supply in aggregate supply, a favorable shift in aggregate supply, sorry, I've been talking for 21 minutes, that's going to decrease inflation overall because we're more efficient, we've got a lower cost of production, prices can decrease, and also the overall growth or the overall production increases as well, which is great. Sometimes, because like I said before, about that bottom bit being the generals, the smallest amount that will be produced regardless, sometimes the favorable shift looks like that. Either way, that's totally fine, however you draw it, as long as it's really clear that it's a favorable shift. And that's essentially it for these graphs. I've said a lot in 20-something minutes. The labeling is incredibly important. But if you have any questions about any of these, like leave a comment below, send me an email. I'm more than happy to help any more with these. But I noticed a lot of graph type questions were coming up and people are asking a lot about it. So if you're doing one video that covers all the graphs, would be excellent. Let me know what topics you want more information on, because I'm more than happy to make these. We've got a month and a half to the exam, so we've got heaps of time to go through more stuff in more detail. On that, I hope you have a wonderful day, and I will see you next time. Goodbye.